Approximately 1 year ago, on November 5th, 2021, this video showed what analysts expected Skyworks Solutions to produce for fiscal year 2022, which ended in September. Analysts were forecasting $11.57, which would have been an 11% growth rate over the previous year. And the video was a widely requested subscriber request for Fast Graphs subscribers and channel subscribers because the stock had fallen from previous highs and started to enter fair value territory. However, this is what Fast Graphs looks like today. Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool. I'm doing another one of these look back videos because I believe there's obviously a lot to learn from looking at past ideas and past discussions, and especially with Skyworks Solutions, which was a subscriber request that I was asked to do last year in November, and I did. And I actually do have a position in this stock, so I do want to close that. And I'll show you here in a moment when and where I really aggressively started investing in the stock. But what I want to discuss is what's happened to Skyworks Solutions when that first video was produced versus what it looks like today. Now, the video was showing Skyworks Solutions last November was expected to earn $11.57. Let's go into the analyst scorecard and look at that. They were expecting $11.55. The company earned $11.24. Okay. Now, that was only 2.68% below what analysts were expecting as far as a forecast. So the company did have a modest drop. It was 7% growth over the previous year. So fiscal 2022 ended in September, I want to point out, ended up doing pretty well for the stock. However, notice this large drop in the stock price. Okay, now I'm going to shorten the time frame here to make this a little more visible. The company's, a quasi-cyclical company, number one. I think you need to take that into consideration. And it does have periods where growth gets very, very high, and then it goes into some periods where growth gets low, and even goes into periods where there'll be some negative growth. But all in all, this has been a pretty powerful growth story, and we'll talk about what the company does here in a moment. But here's what happened. The company earnings came in, or expected to come in now at $9.92 for this fiscal year. They were expected to be over $11.87 previously, a year ago. So that's a big drop in terms of expectations, but it's also approximately a 12% drop from last fiscal year, which ended just a couple of months ago's earnings report. But here's the point I want to make on this. Look at the reaction of the stock price. Look how drastically the market has killed the stock. And, as I often say to you, fundamentals matter, and they matter a lot. So let's kind of look at what we're really seeing here. We are having a drop in earnings. The company is expected to continue to grow long term, and we'll get into that in a moment. But the bottom line is this is a massive overreaction to what would turn out to be the third best year in the company's history. In other words, the high mark was fiscal 2022, where they earned $11.24. But prior to that, the high mark was in 2021, where they earned $10.52. So coming in at $9.92 is still the third most profitable year the company ever had. And I think that's really important to talk about. But, this company now is yielding about 2.67%. It has become very, very attractively valued, in my opinion. It has an earnings yield of over 12% in addition to a 2.7% dividend yield. The company has relatively low debt, and that's very important. And the company has been making some acquisitions, and we'll talk about some of those things here in a moment. But I want to look at some other metrics that we're seeing. So the earnings were a little disappointing, but they still came in pretty well. The company's not losing money. It's not going out of business. It's not filing for bankruptcy. In other words, it's having a bad year, which is not unusual for this company in its long storied history. It's had bad years before and probably will again, because after all, it is a technology stock. And there's a lot of things with the technology cycles that can affect a company like this, but we'll get into what they do here in a moment. But the bottom line is I consider this a significant overreaction. Now, I did not forecast that to happen a year ago when I did the video. And I want to make this statement very strongly. Anybody who believes that there's any guru out there that can accurately forecast short-term stock price movements over the next quarter, year, week, month, or day is, I think, being very naive. This analyst can't do it, and I don't know of any analyst that can. Stock prices are very, very volatile. You look at any stock price graph and see the amount of volatility. And of course, when you take price off of a graph like this, you can see that even when earnings are cyclical, like they've been with Skyworks Solutions, where they have good years and bad years, there's still generally a trend of growth here, but it's a lot less volatile, if you will, than this stock price line, which is all over the place. Okay, so now, the question is, are we looking at an extreme bargain? Are we looking at an extreme overreaction by the market, which is an extraordinary long-term buying opportunity, or we're looking at a company that's really in a lot of trouble? So let's look at some other metrics. As far as diluted earnings, which are GAAP earnings, the company's going to have some, little stress in GAAP. They've made some acquisitions, as I pointed out. There's accounting convention, involved here. But even then, I would still consider this to be a very strong overreaction to what happened to the price. But let's look at, since this is a dividend-paying company, and I want to point out that they just raised their dividend, let's look at all-important cash flows. Cash flows did drop. Operating cash flow in 2022, they did drop, but they're expected to recover very strongly for this fiscal year. And again, that comes down to some of the things the company's been doing as an operating business. Let's look at the all-important free cash flow. Free cash flow also fell, but most importantly, free cash flow is covering this dividend. So let's go ahead and look at the performance report here, and let's look at the dividend record for fiscal 22. At the end of the fiscal year, the company raised their dividend from 56 cents a quarter to 62 cents a quarter, bringing dividend down to $2.30 over $2.06 for the previous year. So cash flows are still supporting, and both free cash flows and operating cash flows are still supporting a strong dividend. And I do also want to point out, when we're looking back at this performance report, that the dividend growth has been extraordinary, but I want to cut a couple of years off of here, to get more realistic. This is what the dividend has been since 2014. And it's been growing at a very incredible rate. But let's look at what the dividend has been since 2017, because we're eliminating that one, aberrant year here. And let me go back to see that you understand. Their first dividend came out in 2014. They paid 22 cents. Then they raised it to 65 cents. That was a 195% increase, then a 62% increase. So if I shorten this time frame a little bit here and get rid of those, you'll see that the company's still raising the dividend by almost 14% a year. And in 2022, they raised it by almost 12%, 11.65%. So the company's dividend record, since they've been paying a dividend, which hasn't been all that long, has been, exemplary for the short time they've been paying a dividend. And as I pointed out, cash flows and free cash flow is still covering the dividend like a blanket. If I look at some other metrics here, like EBIT, earnings before interest and taxes, we can see that the company's having had a mildly down year in 2022, expected to actually recover very strongly in 2023. So fundamentally, this company looks very good. So let's go into some other research here. Let's go into NASDAQ. And let's look at the fourth quarter results that the company produced on November 3rd. And, they delivered record fourth quarter revenues up 14% sequentially and 7% year over year. I'll show a little more about that in a moment. Diluted earnings of 188 and non-GAAP earnings of 302. They delivered record revenue and so on. So they had a really good, year. Moving forward, Skyworks' strong profitability, this is in their earnings report, and cash generations continue to support development of next generation technologies, positioning us for long-term growth and market share gains across diverse markets. In the fiscal fourth quarter last year, they partnered with Vodafone to launch the United Kingdom's first Wi-Fi 6E broadband gateway. They shipped into tri-band fiber gateway for Frontier Communications. They launched advanced connectivity solutions with Amazon, supporting their Wi-Fi 6 power over Ethernet access points. They delivered integrated platforms to the leading 5G smartphone operating equipment manufacturers, including flagship and mid-tier launches at Google and Samsung, among others. They provided programmable timing solutions, and on and on. This company is still performing extremely well. And they have a lot of opportunities in other aspects with the Internet of Things, the rollout of 5G. There's so many opportunities this company does have. Now, if I go into Zacks Equity Research here, we'll kind of look at an overview because, again, I want you to understand what this company does and what it's all about. It's headquartered in Irvine, California. According to Zacks, now they design, manufacture, and market a broad range of high-performance analog and mixed-signal semiconductors that enable wireless connectivity. And that's really the future. The future is expected to grow staggeringly large in wireless connectivity over the next decade or so. The company's products include power amplifiers, front-end modules, radio frequency subsystems, cellular systems, leveraging its core analog technologies. They also offer a diverse portfolio of linear integrated circuits that support automotive, broadband, cellular infrastructure, industrial, and medical applications. All of these, wireless technologies, if you will, are able to talk to each other thanks to the work of Skyworks and some of their competitors. They reported revenue of $549 billion. The company has designed its product portfolio around two markets, and I consider this very important: cellular handsets and analog semiconductors. The handset portfolio includes highly customizable power amplifiers and front-end solutions that are used in a variety of cellular devices from entry-level to multimedia. It's reinforced by approximately 3,950 global patents and other intellectual property. The company's industry-leading technology helps to offer highest levels of product performance and integration. And, there are so many markets that this company is involved in, but the company does have competition from companies like Broadcom, Maxim, Qualcomm, and Qorvo are some of their major competitors. But nevertheless, this is a very powerful technology company. I think it's fiscally fit. It's very healthy. And let's get into that and let's take a look at their fiscal fitness here real quick, just to go through some of the things that I consider important. As far as free cash flow greater than dividend, the company's covering that greatly. I'm going to shorten this to a shorter period of time so you can see it. They're generating substantial free cash flow to cover their dividend. Their operating cash flow growth, has been growing at about 22% on average, but it is somewhat cyclical. They're expected to be down about 17% for this fiscal year. The company has started to buy back shares, and while it's being undervalued here, otherwise it was holding shares stable. I consider now a good time to be doing that. Their operating cash flow has remained greater than their net income, which I think is a positive sign. Their sales revenue growth has been growing at a very nice rate. Last year was one of the lowest rates it's grown at 7.37, but there are obviously years because, again, the cyclicality nature of this business. Their net income has also grown, although it was down, this year. Their debt to equity has increased a little bit because of some acquisitions. The company's margins are continuing to hold up. The company's return on assets are continuing to hold up. Return on equity is continuing to hold up. And return on invested capital is continuing to hold up, although slightly down from fiscal year 2021. So all in all, I consider this a very strong company. It does have some weakness in operating results, but that's not the first time that's happened, and it's going to happen in the future. After all, what happened between last year and this year is we've entered a very weak economy. We're teetering on the verge of a recession. And obviously, the technology has suffered from that, but that's also given us an opportunity to buy technology stocks. It wasn't too long ago when this company, along with a lot of other technology stocks, were trading at nosebleed valuations, and now they've gone the other way. The stocks are very, very undervalued in today's marketplace. So I consider this a very attractive opportunity to take a, real strong look. My original video last year was talking about this being a research candidate. And, I suggested you do more research. We talked about, the stock was about right in here in November and December of last year. We can see this big drawdown. We're starting to see a recovery. Today's market, the stock is still, because there's still some technology weakness out there. It is up a little bit today. There are, most analysts on Seeking Alpha are recommending you buy it. Now, things like Micron Technologies leads the semiconductors lower as new CapEx cuts set to come next year. So they're getting sympathy from other semiconductor companies that are having some, minor issues now. But again, my most important message to you is this. I consider this a tremendous long-term buy. I think the company will end up being a good investment from the discussion last year. But now that the stock has, in other words, from this point here, I think going forward, this stock would still be an attractive buy. It'll turn out to be an attractive buy candidate with an increasing dividend yield. This has created an opportunity that would empower investors to buy more. Now, I am going to show you, I did just that in select accounts that I manage. We did buy some more on June 27th, and we've gone down. We're just almost breaking even on that. But the point is, I was doing my due diligence, and I see this as a big opportunity, not the end of the world. So the stock price reacted much stronger than the fundamentals would indicate that they have. And I think it's real important to look at that from the standpoint of the analyst scorecard. The company did have a miss. Now, their 2-year miss was actually quite good. The company was forecast 2 years in advance to generate about $8.17, and they came in at $11.24. So, analysts do have some trouble occasionally because of the cyclical nature of these companies. But the bottom line is this is a growth story. It continues to grow. It's a strong cash flow machine. The company does have good liquidity. It has a strong balance sheet. It has low debt. It has a growing dividend income. And I think right now we see an opportunity as a long-term investor to acquire this company. And if you've already bought some, it would be a great time to be adding to the position. So I am recommending this stock currently rather strongly for the long term, not for the next 6 months. I have no idea what it'll do in the next month or the next 6 months. But I think if you own this stock over the next decade, you'll be very, very happy you purchased it here. Anyway, this has been Chuck Carnevale saying thanks for watching. And this was a follow-up, a look back. I think some of the lessons that were, learned here from a value investor's point of view is that the market will often overreact. And when the market does overreact, smart value investors exploit those overreactions. We don't worry so much about the short term, especially if you're a dividend growth investor, as I'm pretty well postured right now. This is an opportunity to get a real good dividend yield that has been growing at a very fast rate. Cash flows tend to indicate it's likely to continue to grow at a fast rate. And bottom line is you can buy it at such a low valuation right now that the company becomes, just extremely attractive. Looking at earnings yield, you've got an earnings yield of over 12% on the stock right now. And as most of you know, my minimum threshold is 6.5 to 7. Anyway, this has been Chuck Carnevale saying thanks for watching. I hope you enjoyed this video, this relook at a stock that was talked about last November. So 1 year later, a lot has changed, but it has not changed as much as the stock price would indicate, in my humble opinion. Thanks for watching. If you liked the video, ring the bell. Subscribe to the channel and take a look at Fast Graphs because it is a dynamic tool and the world of investing is always changing, and we do our best to keep up with those changes, as you can see by the adjustments made to the graph here. Thanks for watching, and everybody have a very happy Thanksgiving holiday. Thank you.